Unprecedented volatility just ripped through crypto markets, and what we're witnessing is nothing short of historic. Bitcoin is up 18% from its bottom, now trading back above 98,000, adding roughly 5.2 trillion in market cap in just 48 hours. Ethereum surged 24% from its lows, now back above 3,400, adding another 2.8 trillion across the entire digital asset ecosystem. That's nearly $8 trillion recovered in 2 days. Approximately 42% of the recent 19 trillion wipeout has been erased. And here's what makes this absolutely critical. 8 trillion recovered while retail investors were capitulating at the bottom. This is what institutional accumulation looks like disguised as a market crash. This is algorithmic buying at scale while fear dominates the headlines. The volatility isn't chaos, it's engineering. Bitcoin back over 98,000, Ethereum above 3,400 after the most violent shakeout we've seen since the 2022 bear market bottom. Digital assets just recovered 8 trillion in market capitalization in 48 hours. The data tells a story that most people completely miss. While mainstream media was broadcasting doom and retail investors were panic selling, something else was happening beneath the surface. Whale wallets were accumulating, exchange outflows accelerated, institutional custody solutions saw record inflows. This wasn't a collapse. This was a transfer of wealth from weak hands to strong hands at calculated price levels. Our analysis has always remained independent and data-driven. We don't chase hype and we don't sugarcoat reality. The markets are manipulated by institutional players with resources that dwarf retail participation. The system is designed to shake out emotional traders before major moves higher. For those seeking sensationalized content, there are plenty of channels that will tell you what you want to hear. This channel exists to provide researched analysis and unfiltered truth, regardless of how uncomfortable that might be. We've never asked for money, and we never will. Anyone claiming to represent us while soliciting funds is a scammer and should be reported immediately. Our focus remains on education and providing context that helps you make informed decisions in an increasingly complex financial landscape. Now, here's what makes this 8 trillion reversal even more significant. On-chain data is showing something that hasn't happened since early 2023. Bitcoin leaving exchanges at the fastest rate in 18 months. Over 127,000 Bitcoin withdrawn from centralized exchanges in just 72 hours. That's $12.4 billion moving into cold storage and self-custody solutions. When supply leaves liquid markets during a price recovery, it creates conditions for explosive moves higher. The float available for trading contracts, while demand from institutional buyers remains steady or increases. This is textbook supply shock setup. Ethereum tells an even more compelling story. The amount of ETH staked just hit a new all-time high despite the 24% crash and recovery. Over 34 million ETH now locked in staking contracts, representing 28% of total supply. That's $115 billion removed from circulating supply. Stakers didn't panic. They didn't unstake during the crash. They held through volatility and many added to positions. This is conviction. This is long-term positioning by participants who understand what's being built. But let's talk about what really happened last week. The crash wasn't organic, it was coordinated. Funding rates on perpetual futures contracts had reached extreme levels. Over-leveraged long positions were stacked like dominoes. Institutional players recognized the opportunity. Massive sell orders hit thin liquidity zones during Asian trading hours. Stop losses triggered in cascading fashion. Liquidations accelerated the move. Over 4.2 billion in leveraged positions were liquidated in 36 hours. That's forced selling. That's algorithmic margin calls creating artificial supply. And while that was happening, spot buyers stepped in at predetermined levels. Coinbase premium turned positive. Large wallet addresses showed accumulation patterns. The crash was the mechanism. The accumulation was the objective. Let's connect this to the broader macro picture because nothing happens in isolation. The Federal Reserve just released minutes from their last meeting and the language has shifted. Concerns about inflation persistence are growing. Multiple Fed officials mentioned the possibility of pausing rate cuts if economic data remains hot. Treasury yields spiked on the news. The 10-year briefly touched 4.73% before settling back. When real yields rise, risk assets typically face pressure. But Bitcoin and Ethereum recovered anyway. This is significant. It suggests that digital assets are beginning to trade less like risk assets and more like alternative monetary systems. The correlation that dominated for 3 years is breaking down. Now let's discuss what major institutions are doing while retail capitulates. MicroStrategy just announced another Bitcoin acquisition. They purchased an additional 18,300 Bitcoin at an average price of 89,400. Total holdings now exceed 528,000 Bitcoin, worth over 51 billion at current prices. They bought the dip. Again, this is the 47th consecutive week of accumulation. Meanwhile, BlackRock's Bitcoin ETF saw inflows of $890 million over the past 3 trading days. Fidelity's Bitcoin ETF added $623 million. These aren't retail flows. Retail was selling. These are institutional allocations happening while fear dominates social media and financial news coverage. Ethereum is seeing similar institutional interest, but through different mechanisms. The number of wallets holding over 10,000 ETH just reached the highest level in 2 years. These are not retail wallets. These are institutional positions, DAO treasuries, and high net worth individuals accumulating during volatility. Additionally, decentralized finance protocols saw record inflows during the crash. Over $6.7 billion moved into lending protocols in 48 hours as participants deposited assets to earn yield rather than sell into panic. This represents sophisticated market participants using volatility to optimize returns rather than exiting positions emotionally. The regulatory landscape is shifting in ways that most people aren't paying attention to. The European Union just finalized implementation guidelines for MiCA regulations. These create legal frameworks for digital asset issuance, custody, and trading across all member states. While regulatory clarity often seems like bureaucratic noise, it removes a massive uncertainty premium that has suppressed institutional participation. Insurance companies, pension funds, and sovereign wealth funds have been waiting for regulatory frameworks before allocating capital. That framework is now in place across the world's second largest economic bloc. The capital that can now legally flow into digital assets is measured in trillions, not billions. Asia is accelerating adoption at a pace that Western observers consistently underestimate. Hong Kong just approved 3 additional spot Bitcoin ETFs and 2 Ethereum ETFs. Singapore's Monetary Authority expanded licensing for digital asset service providers. South Korea's National Pension Service, which manages over $800 billion in assets, is finalizing frameworks for cryptocurrency allocation. These aren't speculative moves by retail investors. These are policy decisions by governments and institutional asset managers, representing trillions in capital. The narrative that crypto is fringe or speculative is becoming divorced from reality on the ground in major financial centers. But here's where it gets really interesting. Tether, the largest stablecoin with over $142 billion in circulation, just reported record profits for the 4th quarter. They generated $5.2 billion in net income, primarily from treasury holdings yielding over 4%. This matters because Tether acts as the primary liquidity mechanism for crypto markets globally. When Tether profits increase, it demonstrates sustained demand for dollar-denominated stablecoins to facilitate digital asset trading. That $142 billion in circulation represents dry powder sitting on the sidelines of crypto markets. When that capital deploys into Bitcoin and Ethereum during the next leg higher, the moves will be violent and sustained. Circle, issuer of USDC, reported similar trends. USDC circulation increased by $8.4 billion over the past 30 days despite market volatility. New capital entered the ecosystem during the crash. Participants converted fiat to stablecoins anticipating buying opportunities. This is exactly what happens before major rallies. Capital positions itself in stablecoins waiting for entry points, then deploys rapidly when technical conditions align. We saw $12.7 billion in stablecoin inflows to exchanges in the 72 hours following the bottom. That capital didn't sit idle. It bought Bitcoin at 82,000 and Ethereum at 2,750. Now those positions are up 18% and 24% respectively in 48 hours. Let's address the elephant in the room. Grayscale Bitcoin Trust has been a consistent source of selling pressure since converting to an ETF structure. Their outflows have been relentless, creating constant headwinds for price appreciation. But something changed last week. Outflows from GBTC dropped to the lowest level since the ETF conversion. Only 23 million left the fund during the crash, compared to daily outflows exceeding 200 million in previous months. This suggests that the remaining holders are long-term believers who won't sell regardless of volatility. The selling pressure that has suppressed Bitcoin for over a year is exhausting. When that source of supply disappears, price discovery moves in one direction. Mining economics provide another critical signal. Despite the 18% crash, Bitcoin mining difficulty just increased by 3.2%. Miners are expanding operations, not contracting. This only makes sense if they anticipate significantly higher prices in the near to medium term. Mining Bitcoin currently costs between $42,000 and $68,000, depending on energy costs and hardware efficiency. With Bitcoin trading at $98,000, miners remain highly profitable, but they're not selling. Miner wallet balances increased during the crash. They held inventory rather than liquidating to cover operational costs. This indicates confidence that current prices represent the lower bound of a range, not the beginning of a deeper decline. Ethereum's merge to proof of stake created entirely different economics. There is no miner selling pressure. Validators earn rewards, but those rewards are predominantly restaked to compound returns. The sell pressure that characterized Ethereum for years has been structurally removed. Additionally, Ethereum's fee burn mechanism has destroyed over 4.2 million ETH since implementation. That's 14.2 billion in permanent supply reduction. When you combine removal of miner selling, increasing stake supply, and ongoing burn mechanisms, Ethereum's supply dynamics are unlike anything we've seen in digital assets. The float available for trading shrinks while institutional demand increases. Let's talk about derivatives positioning, because this is where the next move gets telegraphed. Options markets are showing something fascinating. The put-call ratio on Bitcoin options collapsed from 1.8 to 0.6 in 48 hours. This means dramatically more call buying relative to put buying. Traders are positioning for upside despite just experiencing a violent crash. Additionally, implied volatility dropped from 120 to 78 in 2 days. When volatility compresses after extreme moves, it creates conditions for explosive breaks in either direction. Given the accumulation patterns, exchange, outflows, and institutional buying, the probability favors upside resolution. Ethereum options show even more bullish positioning. Open interest in calls expiring in March is 3.2 times higher than puts. Strike prices cluster around 4,000 and 4,500. The market is pricing in a move to new highs within the next 45 days. This isn't retail speculation. Options markets are dominated by sophisticated traders and market makers hedging institutional flows. When positioning becomes this skewed, it often precedes significant directional moves. Now let's address the risks, because pretending they don't exist is foolish. Global liquidity conditions remain the primary driver of risk asset performance. If the Federal Reserve maintains restrictive policy for longer than markets anticipate, digital assets will face sustained headwinds. Additionally, regulatory uncertainty in the United States continues, despite progress in other jurisdictions. The SEC's approach to crypto regulation remains hostile and unpredictable. Any negative regulatory development can trigger immediate selling regardless of fundamental strength. Geopolitical tensions present another risk: escalation. In any major conflict, historically drives capital toward traditional safe havens like U.S. treasuries and gold. Digital assets, despite philosophical positioning as alternative monetary systems, still trade with risk-on characteristics during geopolitical shocks. A major escalation could override bullish technical and fundamental setups. Systemic risks in traditional finance also matter. The recent volatility in Japanese government bonds created ripple effects across all asset classes. Japan's debt dynamics remain unsustainable. When the next crisis emerges from that situation, global deleveraging will impact crypto markets regardless of digital asset fundamentals. Correlation goes to 1 during liquidity crises. But here's the bullish case that overrides short-term risks. The infrastructure being built during this period will support the next bull market. Layer 2 scaling solutions on Ethereum are processing millions of transactions daily at fractions of a cent in fees. This makes decentralized applications economically viable for mainstream adoption. Real-world asset tokenization is accelerating with major financial institutions launching pilot programs. BlackRock tokenized a money market fund. JP Morgan is using blockchain for overnight repo settlements. These aren't experiments. These are production systems handling billions in value. Central bank digital currencies are advancing globally. Over 130 countries representing 98% of global GDP are exploring or piloting CBDCs. Whether you view this as bullish or bearish for decentralized cryptocurrencies, it validates the underlying technology and creates infrastructure that increases overall digital asset adoption. Once central banks operate on blockchain rails, the technical barriers separating centralized and decentralized systems diminish. The correlation between Bitcoin and gold is strengthening after years of divergence. Both are increasingly viewed as alternatives to fiat currency systems facing structural challenges. Gold is trading at all-time highs above 4,900. Bitcoin recovered to 98,000. Silver surged 20%. These moves are happening simultaneously because they represent the same trade. Hard assets with supply constraints perform during periods of monetary instability and currency debasement. The playbook is identical, whether you're buying gold, silver, or Bitcoin. You're exiting claims on fiat currencies in favor of scarce assets with no counterparty risk. So where does this leave us? Number 1, 8 trillion recovered in 48 hours. Bitcoin up 18%, Ethereum up 24%. This proves the crash was forced liquidation and the recovery is institutional accumulation. Retail sold the bottom while whales bought. Exchange outflows hit 18-month highs. Stablecoin inflows positioned capital for deployment. The physical Bitcoin supply leaving exchanges creates supply shock conditions. Number 2, Institutional adoption is accelerating regardless of price volatility. MicroStrategy buying again, BlackRock and Fidelity. ETF inflows exceeding 1.5 billion during the crash. European regulatory clarity removing institutional barriers. Asian governments expanding digital asset frameworks. This capital represents long-term allocation, not speculative trading. Number 3, on-chain metrics confirm bullish positioning. Staked Ethereum at all-time highs. Mining difficulty increasing despite crash. Whale wallets accumulating. Derivatives positioning skewed heavily toward calls. These are not signals that precede deeper declines. These are signals that confirm institutional participants view current levels as attractive entry points for long-term positions. The unresolved tension is this: 8 trillion recovered in 48 hours demonstrates underlying strength, but macroeconomic headwinds from Federal Reserve policy and global liquidity conditions create ongoing volatility risk. Does another forced liquidation event take us lower before the next sustained rally? Or does the supply shock from exchange outflows and institutional accumulation drive us directly to new all-time highs? March is significant for multiple reasons. Ethereum's next major upgrade is scheduled. Bitcoin options with over 8 billion in notional value expire. Quarterly rebalancing from institutional portfolios occurs. These events create natural catalysts for volatility and directional moves. The setup favors upside, but requires navigating near-term chop. Do your own research. Understand the risks. Macroeconomic conditions are uncertain. Regulatory developments remain unpredictable. Geopolitical tensions could escalate. But 8 trillion in 48 hours, 127,000 Bitcoin leaving exchanges, institutional inflows during maximum fear. These signals are also real. The paper markets create volatility. The on-chain fundamentals create the floor. Know which time frame you're trading. Invest based on data, not emotion. Use your own judgment. Don't follow anyone blindly.